Welcome back to the channel. Today, we're diving into one of the most important concepts in business finance, profitability analysis. If you've ever wondered why some companies grow faster, why investors prefer certain stocks, or why two businesses with the same revenue make completely different profits, then this video is for you. Stick around to the end, because I'll break everything down in simple terms without complicated math. Section 1. What is profitability analysis? Profitability analysis is basically a way to evaluate how well a company turns its revenue into profit. It answers questions like, are we making enough money? Are we charging the right price? Are costs eating up our earnings? Is the business model actually working? Think of it like a health checkup, but for money. Just like a doctor uses blood pressure or heart rate to check your health, businesses use profitability ratios to check financial health. Section 2. Why profitability matters. Let's imagine two businesses. Business A makes $1 million in sales, but barely keeps anything after expenses. Business B makes $300,000 in sales, but keeps a big portion as profit. Which one is healthier? Most people would guess Business A, because the revenue is bigger. But if Business B keeps a higher percentage of the money it earns, it's actually more profitable. Profitability analysis helps you see the real story behind the numbers, not just the flashy revenue. Reasons it's important. 1. Investors use it to decide where to put their money. 2. Managers use it to control costs and improve efficiency. 3. Banks use it to decide whether to give loans. 4. Business owners use it to set prices and plan for the future. A company can survive for a while with low revenue, but it cannot survive long with low profitability. Section 3A. Key profitability ratios. We'll look at the major ratios with minimal math, focusing instead on the meaning behind them. 1. Gross profit margin. This tells you how much money is left after paying for the product or service itself. If you sell something for $100 and it costs you $60 to produce or buy, the gross profit is $40. High gross margin gives good pricing power. Low gross margin gives competition is high or costs are rising. Companies like software firms often have very high margins. Grocery stores have very low margins but rely on high volume. 2. Operating profit margin. Now we go deeper. This margin considers all operating expenses, such as salaries, rent, marketing, utilities. This tells you if the company is efficient. A company might have a strong gross margin but still end up weak if operating costs are out of control. Operating margin helps answer questions like, are we overspending? Are we running the business efficiently? 3. Net profit margin. This is the final, bottom line margin. It considers everything: operating expenses, interest, taxes. It shows what percentage of sales becomes actual profit. Higher net margin equals better long-term sustainability. Low net margin equals the business may be struggling with cost management or pricing. 4. Return on assets ROA. This ratio shows how efficiently a company uses its assets to generate profit. If a business buys machines, buildings, or equipment, ROA tells us whether those investments are paying off. Higher ROA equals assets are being used effectively. 5. Return on equity ROE. This ratio tells investors how much return they are getting for every dollar they put in. If you are an investor, this is one of the first things you look at. High ROE equals the company is creating strong returns using shareholders' money. Low ROE equals shareholder money is not being used efficiently. Section 4. The story behind the numbers. Profitability ratios are helpful, but they don't tell the full story alone. We must understand what's happening behind the numbers. Examples: a company with low profit margin might still be healthy if it is investing heavily in growth, it operates in a high-volume industry, it is in the early stage of expansion. A company with high margin might be in danger if competition is catching up. Customers are switching to cheaper alternatives, costs are rising faster than prices. Profitability analysis is not just math, it's about analyzing the business model, the market, and the company's strategy. Section 5. Internal vs. External factors affecting profitability. Internal factors. These are things the company can control. Pricing strategy, cost control, operational efficiency. Product quality, workforce productivity. A company with strong management always focuses on these. External factors. These are things outside the company's control. Economic conditions, interest rates, competition. Changes in customer behavior, government regulations. Even a well-managed company can struggle if the external environment is tough. Section 6. How companies improve profitability. Here are common strategies. 1. Increase revenue without raising costs. Examples: better marketing, upselling and cross-selling, launching new products. 2. Reduce cost of goods sold. Examples: negotiating with suppliers, switching materials, buying in bulk. 3. Improve operational efficiency. Examples: automation, better workflow, training employees. 4. Adjust pricing strategy. Sometimes small price changes can create big profit changes. 5. Focus on high-margin products or services. Not all products contribute equally. Companies often drop low-profit items to boost overall margins. This brings us to the end of part 1 of our deep dive into profitability analysis. We covered what profitability means, why it's important, the major ratios, and the factors that influence them. In the next part, we'll explore real-world examples, case studies, and how you can apply these principles to your own business or financial analysis. If you found this helpful, don't forget to like the video, subscribe, and comment below with the next financial topic you want me to break down. Thanks for watching, and I'll see you in the next one.